Pascal Investment Advisors was created in 2002 and we've been operating in that universe for 15 years, creating a sizable goodwill, meeting companies, seeing how they evolved over the past 15 years. Some of them have changed during the 2007-2008 crisis, some of them haven't. And we like to pick companies that are able to adapt and that are able to survive. So the investment philosophy starts from the company in which we want to invest. We want to invest in companies with great management teams. We want to invest in companies with sound balance sheet. We like companies with pricing powers, defendable market share. And that often leads to significant free cash flow generation, which is the key metric for us in order to pick a company and put it as an investment within the fund. That often leads as well to high return on capital employed. Finally, one other aspect fairly important relates to the fact that we like to see our interest being in line with the key decision makers within the company. The addressable universe for us comprises approximately 2,000 companies. We have models on 700 to 800 as of today, and we keep constantly increasing that database of models, which is the key filter for us in terms of finding new investment opportunities. Since inception in May 2015, the fund has returned more than 30%. We don't think this is a coincidence, and we think that will continue in the future, given the fact it's the result of the method, it's the result of the selection, and the result of the concentration we want to put in the portfolio going forward. The weighting towards industrial might actually be misleading within the fund. There's a tendency within smaller companies to put in industrial everything that you cannot put elsewhere. More important than industrial exposure, we look at subsector exposure, which obviously gives us more granularity into the concentration that we have. That's one of the beauty about smaller companies as well, is that there is a vast majority of industries, a vast majority of type of business in which we can invest, and that provides us with significant differentiation within the business models in which we are invested. Outlook for the European market looks better as of today, and especially since the beginning of the year. After years of limited growth in Europe, we start to see growth coming back. We start to see unemployment coming down, which obviously is going to be in favor of the company in which we are invested. At the same time, this is not a key criteria for us to invest. We are trying to find ways to protect ourselves vis-à-vis market evolution. We're trying to find companies where there is a substantial discount between the market value and the intrinsic value or the fair value that comes out of our models. And this is how we protect, this is how we preserve capital going forward. So meeting companies, having the database of model is the way for us to be protected from short-term market movements we may have in the coming month, especially in Europe. As of today, we think Switzerland, especially with the negative interest rates, comes with higher valuation. Scandinavia is another area of Europe where valuations are fairly rich. At the same time, France has been reasonably low in terms of valuation because of the bad press that the country had, especially in 2016. And we exploited that more in 2016 than in 2017. The discount has kind of vanished, but still it represents more than 30% of the portfolio. So in spite of investing in small and mid companies, the fund remains fairly liquid. More than 80% of the fund can be liquidated in less than 10 days. So there's often perception that smaller companies are less liquid, obviously, than larger ones. But in practice, this remains a fairly liquid product. Also, with regards to the capacity of the strategy, we think the capacity is approximately 500 million euros. The fund stands at 150 million today, so there's still ample room to grow into the universe and into the companies that we like to pick and choose going forward.